From a tax perspective, cryptocurrency is generally treated as property rather than cash, and that single classification shapes almost every tax outcome investors experience because it means that many everyday crypto actions are viewed by tax authorities as disposals of an asset rather than simple payments or transfers. When you buy cryptocurrency such as Bitcoin, Ethereum, or any other digital asset and simply hold it in your wallet, there is usually no immediate tax consequence because no taxable event has occurred yet. You have merely acquired property. However, the moment you sell that cryptocurrency for fiat currency, trade it for another coin or token, or even use it to purchase goods or services, you may be triggering a taxable event that must be reported. For example, if you bought Bitcoin at a lower price and later sold it when the price increased, the difference between your purchase price as known as your cost basis and your selling price is considered a capital gain, which may be subject to tax. Similarly, if you swap Bitcoin for Ethereum, many people mistakenly assume this is a tax-free trade because no cash is involved, but from a tax standpoint, you are effectively disposing of one piece of property and acquiring another, meaning any gain or loss on the Bitcoin must be calculated and reported. Even spending crypto on something small, such as buying a coffee, paying for a subscription, or purchasing electronics, can create a taxable event if the value of the crypto has increased since you acquired it, because you are using appreciated property to make a purchase. Capital gains are typically divided into short-term and long-term categories, and this distinction plays a major role in how much tax you ultimately owe. Short-term capital gains generally apply to assets held for 1 year or less and are often taxed at higher rates, usually aligned with ordinary income tax brackets, which can significantly increase your tax bill if you trade frequently. Long-term capital gains, on the other hand, apply to assets held for more than 1 year and are often taxed at lower, more favorable rates, rewarding investors who take a longer-term approach. This is why understanding holding periods is so critical in crypto tax planning, as simply waiting to sell until you cross the 1-year threshold can sometimes lead to substantial tax savings. Losses are also an important part of the equation because if you sell or trade crypto for less than what you paid, you may realize a capital loss, which can often be used to offset capital gains and reduce your overall tax liability. Accurate record keeping becomes essential in this environment as you need to track purchase dates, prices, transaction fees, and disposal values for every transaction to correctly calculate gains and losses. Because crypto transactions can happen across multiple exchanges, wallets, and blockchains, it is easy for records to become fragmented or incomplete, which can lead to errors or missed reporting. Ultimately, understanding that crypto is treated as property, recognizing which actions trigger taxable events, and knowing how gains are categorized are the foundation of reducing your crypto tax bill, because once you grasp these basics, you are better equipped to plan transactions strategically, avoid unpleasant surprises at tax time, and make informed decisions that align both with your investment goals and your tax obligations. One of the biggest and most costly mistakes crypto investors consistently make is poor record keeping, and as an accountant, this is something I cannot emphasize strongly enough because even profitable investments can turn into tax nightmares when documentation is incomplete or inaccurate. Cryptocurrency moves incredibly fast across multiple wallets, exchanges, blockchains, and even decentralized platforms, and without a disciplined system for tracking transactions, it becomes almost impossible to accurately calculate what you owe or what you could legally save at tax time. Every crypto transaction should be documented with clear details, including the purchase date, the amount acquired, the cost basis in your local currency, the date of sale or disposal, the fair market value at the time of that transaction, and any associated transaction fees such as gas fees or exchange commissions. These fees are especially important because they often adjust your cost basis or reduce your taxable gain, meaning that failing to record them can cause you to overpay taxes without realizing it. In addition to prices and dates, you should also keep track of which wallet or exchange was used for each transaction because funds frequently move between platforms, and without proper labeling, transfers can easily be mistaken for taxable disposals. Many investors assume that exchanges will provide complete and accurate tax reports, but this is a dangerous assumption as exchange data is often incomplete, limited to activity on that specific platform, or missing historical pricing, especially if you transferred assets in from another wallet. Relying on memory, screenshots, or partial transaction histories months or years later can lead to errors that compound over time, resulting in incorrect gain calculations, missed losses, or inconsistent reporting, all of which can raise red flags during a tax review or audit. Poor record keeping doesn't just risk overpaying taxes, it can also expose you to penalties, interest, and unnecessary stress if tax authorities request supporting documentation and you are unable to clearly explain how your numbers were calculated. This is why using dedicated crypto tax software or maintaining a clean, well-organized transaction log is not just convenient, but essential for anyone actively investing or trading in digital assets. Quality crypto tax software can automatically import transactions from exchanges and wallets, apply correct cost basis methods, track holding periods, and generate reports that align with tax regulations, dramatically reducing the chance of human error. For investors who prefer a manual approach, maintaining a detailed spreadsheet that is updated regularly can also be effective, as long as it includes all relevant data and is consistently reconciled with blockchain records. Accurate records allow you to correctly calculate gains and losses, strategically harvest losses to offset gains, and identify opportunities for long-term tax efficiency, such as holding assets long enough to qualify for lower tax rates. Just as importantly, strong documentation gives you confidence and protection because if authorities ever ask questions, you can clearly demonstrate how each figure was derived and show that you made a good faith effort to comply with tax rules. In the world of crypto, where regulations continue to evolve and scrutiny is increasing, clean records are not optional. They are the foundation of responsible investing, smarter tax planning, and peace of mind, ensuring that your financial success in digital assets is not undermined by preventable tax problems later on. Now let's talk strategy, because this is truly where crypto investors can legally and effectively reduce their tax burden. 6. And understanding the tools available can make a significant difference between overpaying and keeping more of your hard-earned gains, starting with one of the most powerful techniques, tax loss harvesting. Tax loss harvesting involves strategically selling assets that have declined in value in order to realize a capital loss, which can then offset gains from profitable trades, reducing your overall taxable income. This method requires careful planning and record keeping because you need to ensure that the losses are properly documented and that the transactions comply with rules in your jurisdiction, such as wash sale restrictions, which can prevent immediate repurchases from being counted for tax purposes. Beyond harvesting losses, timing is a critical component of tax strategy because how long you hold an asset directly affects whether gains are classified as short-term or long-term, and long-term gains are often taxed at a significantly lower rate than short-term gains, sometimes saving investors tens of thousands of dollars, depending on the size of the transaction. For example, Holding a cryptocurrency for just over a year before selling can turn what would have been a high tax short term gain into a more favorably taxed long term gain, which is why understanding and planning around holding periods is so essential. In addition to timing and harvesting strategies, it's important to consider every cost associated with your crypto activity because certain expenses may be deductible, further reducing taxable income. Transaction fees, network or gas fees paid to move crypto between wallets or exchanges, exchange trading fees, and even some professional costs such as accounting or advisory services related to your crypto investments may be deductible depending on your country's tax rules, and these deductions can add up significantly over the course of a year. The key point of strategic tax planning is that it isn't about evading taxes, which is illegal, but about understanding the rules thoroughly so that you are not paying more than you legitimately owe. For active traders, this means monitoring your portfolio regularly, planning trades with tax consequences in mind, and using tools such as crypto tax software to simulate different scenarios and forecast potential gains, losses, and tax liabilities before executing trades. Even small adjustments, like deciding whether to sell a portion of your holdings now or wait until next year, can have a substantial impact on your tax bill, especially when dealing with volatile assets like cryptocurrency, where prices can swing dramatically in a short period. Strategic planning also extends to diversification and asset allocation, because rebalancing your portfolio with an eye toward tax efficiency can allow you to realize losses in some areas while preserving long-term gains in others, optimizing both growth and tax outcomes simultaneously. Ultimately, smart crypto tax planning is about making informed decisions, leveraging the legal tools available to minimize taxable income, and ensuring that every transaction is considered in the broader context of your overall financial picture. By combining careful record keeping, tax loss harvesting, thoughtful timing, and awareness of potential deductions, you position yourself to reduce your tax burden responsibly, avoid surprises during tax season, and maintain compliance with authorities, all while keeping more of the wealth you generate through cryptocurrency investments. The goal is not to escape taxation, which could lead to penalties, interest, and legal trouble, but to engage in proactive, informed management of your assets so that your taxes reflect exactly what you owe and nothing more, allowing you to retain more capital for reinvestment, financial growth, and long-term security. This strategic approach transforms crypto taxation from a source of anxiety into an opportunity to optimize your financial outcomes while remaining fully compliant with the law, demonstrating that careful planning, discipline, and knowledge of available tools are the cornerstones of reducing your crypto tax liability effectively and legally. Finally, one of the most important yet often overlooked aspects of managing cryptocurrency taxes is the value of professional advice, because crypto tax rules are evolving at a pace that few individual investors can keep up with, and what may have been perfectly legal or advantageous last year could change significantly in the next tax season, creating unexpected liabilities or compliance risks. Working with an accountant or tax professional who specializes in digital assets is not just a convenience. It's a critical component of a smart investment strategy, especially as the complexity of crypto transactions increases with activities like staking, mining, decentralized finance, DeFi participation, trading non-fungible tokens, CNFTs, and utilizing international exchanges that may have unique reporting requirements and tax implications. A knowledgeable professional can help you navigate the intricate rules that govern crypto taxation, ensuring that all transactions are accurately recorded, gains and losses are correctly calculated, and any deductions or credits that you are eligible for are claimed, reducing the likelihood of overpaying or underreporting, both of which carry serious consequences. Moreover, professional advice allows you to optimize reporting strategies by identifying opportunities to reduce taxable income legally, such as through tax loss harvesting, appropriate holding periods, or deducting qualifying expenses like transaction fees and professional services, which might otherwise be overlooked if you attempt to manage your taxes entirely on your own. The breadth of activities within the crypto ecosystem means that even seemingly straightforward transactions can have complicated tax effects. For instance, staking rewards are often treated as ordinary income at the time they are received, while mining profits may be considered self-employment income, and DeFi activities such as lending or yield farming can create multiple taxable events in rapid succession, all of which require meticulous tracking and precise reporting. An accountant experienced with digital assets can help you interpret the rules correctly, maintain accurate records, and apply tax treatments appropriately, which is particularly critical when engaging with NFTs or cross-border exchanges, as international transactions can introduce additional reporting obligations and foreign tax considerations. Beyond ensuring compliance, professional guidance offers peace of mind because tax authorities are increasingly scrutinizing crypto activity, and errors, omissions, or misinterpretations, even unintentional ones, can lead to audits, penalties, or costly corrections. Viewing crypto taxes as an integral part of your investment strategy rather than an afterthought at the end of the year transforms the way you approach trading and portfolio management, allowing you to make informed decisions that maximize returns while minimizing unnecessary tax burdens. By involving a professional early and consistently, you also benefit from forward-looking advice, such as structuring transactions to take advantage of favorable tax treatments, planning for long-term gains, or timing disposals strategically to optimize outcomes, which can be far more effective than reactive compliance efforts once a tax deadline approaches. In essence, professional advice helps you bridge the gap between complex regulations and practical financial decision making, ensuring that every move within your crypto portfolio is aligned with both your investment goals and your tax obligations. When handled correctly, professional guidance not only protects your profits and reduces the risk of penalties, but it also safeguards your peace of mind, enabling you to focus on growing your wealth rather than worrying about compliance errors or missed opportunities. Over time, this approach compounds because each year of accurate, strategic management builds a foundation of financial clarity and security, reinforcing the long-term growth of your investments while keeping you fully compliant with evolving regulations. Ultimately, incorporating professional advice into your crypto tax strategy is not a luxury. It is a necessity for anyone serious about protecting their wealth, optimizing reporting, and navigating the increasingly complex landscape of digital asset taxation, and it ensures that your profits, your peace of mind, and your future financial security remain intact, allowing you to confidently participate in the crypto market without fear of unexpected tax consequences.